Hi, I'm Stuart Jackson, Senior Analyst at Montgomery Investment Management. Welcome to this week's video insight. The quality of a business is paramount in identifying investment opportunities. A few weeks ago, I wrote a post on Porter's 5 forces. Porter analysis involves an investigation of the threat of new entrants, the power of suppliers, power of customers, the availability of substitutes and existing competitors in order to assess the sustainability of the returns a company can generate. These are important considerations in looking at the quality of a company. In his post from earlier this week, Chris DeMasi discussed the benefits of pricing power in delivering earnings growth. If a company has power in negotiating with customers because few alternatives in terms of substitutes exist, and it's a product they need or is demanded of them by their customers, then a company has pricing power. Pricing power will invariably allow a company to generate a return above its cost of capital, but it also yields another major benefit. One of the mistakes I've seen younger analysts make is in basing an investment case on overly optimistic earnings growth assumptions. This will often stem from an extrapolation of past results assuming a market growth rate, then adding in a management estimate of benefits from cost reductions or efficiency strategies. Expectations of management are usually based on what they can see at any given point in time. Management usually sets a strategy to optimise the performance of a business for the foreseen circumstances. However, the real-world outcome is a mix of foreseeable and unforeseeable influences. External factors impact companies all the time. Sometimes these factors are positive for a company, but more often than not, they'll create challenges. Pricing power allows a company to offset negative external impacts, protecting investor returns and cash flow. Pricing power gives a company the ability to remain in control of its own destiny rather than merely riding the waves of external factors. The ability of a company to mitigate the impact of negative external factors is the best test of its pricing power. Commodity companies are clear examples of businesses without pricing power. Their earnings and share price performance in the face of slowing demand from China and slowing emerging market economic growth more broadly demonstrates their inability to control their own destiny. This means as an investor, your ability to generate superior returns from resources stocks largely depends on your ability to forecast these external factors better than the broader market. Another example is Goodman Fielder. The company underfunded its marketing budget for many years. As long as the market conditions were stable, this boosted margins. However, as soon as conditions became more difficult, such as wheat price spikes that resulted in significant input cost inflation, the company had no ability to pass the extra costs on to consumers through higher prices because it had stopped talking to them. Invariably, external factors were absorbed by margins, leading to declining earnings, returns and dividends for shareholders over a long period of time. Management would respond with a strategy to restructure the business for the changing circumstances, but without fixing the core problem of underinvestment in the brands, the company was doomed to repeat the same sequence of events when the next external situation arose. That's it for this week. We'll be back next week. In the meantime, you can follow us on Facebook and Twitter.